Well, good morning, good afternoon, good evening, everybody. Welcome back to the ICC International Trade and Prosperity Week. We've had a fantastic day today with a session on human rights, business and human rights this morning. This afternoon, we've got two sessions back to back. The first one is on the big topic really of the week. We've been talking about SMEs an awful lot all the way through the week and the importance of supporting SMEs to help drive the recovery, reset the economy towards a more sustainable, green, inclusive future. This session is all about enabling SMEs to access finance, removing barriers to short-term working capital, trade finance, that is. So we've got a terrific lineup. Please use the live discussion. We'll be in the live discussion, post your questions there, and we'll pick those up in the panel. But what I'd like to do now is just introduce you to our keynote speaker, Sir Douglas Flint, CBE. Sir Douglas is the chair of Aberdeen, a board member of the ICC here in the UK, and the former chair of HSBC. So we're extremely lucky to have Douglas with us. There are a few people, I think, out there in industry who really understand this agenda like he does. So Douglas, if I can hand over to you, and I'll shoot off the screen. Thank you.
Chris, thanks very much. It's a great pleasure to have the opportunity to make some opening remarks on what is a hugely important subject at a time when the global community is obsessively and rightly focused on building back better, addressing the sustainable infrastructure requirements inherent in the transition to net zero, and rebuilding economic growth to fund the extraordinary expansion of debt that's been taken on during the pandemic. All of these objectives require an expansion of global trade, in part, which will be delivered through removing barriers to and reducing costs incurred in the facilitation of that trade. Yet only last week, Asia Development Bank stated that the current global trade finance gap, that is, requests for trade finance which have been declined, had expanded to $1.7 trillion, even as the value of trade had shrunk due to the pandemic. And within that figure, in spite of various support measures, SMEs bore a disproportionate share relative to their overall contribution to global trade. It's also worth noting that the trade finance gap hasn't been below $1.5 trillion since the 2008 financial crisis, when regulators, governments stepped in to stabilize capital markets. The global financial crisis of 2008-9 was clearly very different in its root cause from the COVID-19 pandemic crisis. But there are similarities and learnings from both that are helpful to guiding us to what needs to be done to build greater trade finance resilience and reduce the trade finance gap. I'd highlight the following. In a crisis, banks bring capital home. They concentrate on existing customers rather than new, and they prioritize protecting the domestic economy. Uncertainties reduce risk appetite and accentuate the perceived cost of that risk. Accounting and regulatory models are pro-cyclical, which reduces capital capacity. And emerging and developing countries see external finance severely constrained, given concerns over access to foreign currency liquidity and the strength of their domestic banking systems, both of which are critical elements to the availability of trade finance through the correspondent banking system. However, during this pandemic, there were lessons that had been learned from the global financial crisis. Banks went into the pandemic more liquid and with much higher capital levels and buffers. Central bank support was enormous, both in terms of its immediacy, for both individuals and corporates, and in the provision of foreign currency. And the multilateral development banks extended a whole range of trade finance support, for example, through deferred payment and guarantee schemes. But barriers and obstacles remained, many of which had been introduced or strengthened in the aftermath of the global financial crisis, at that time to bolster the integrity of the financial system. Measures to enhance protection against financial crime and terrorist financing in terms of expanded know your customer and anti-money laundering controls. Those controls now had to deal on top of the financial crime aspects with a whole panoply of COVID-related supply chain disruptions, people being absent from the office through illness, severely constrained physical document flows, delays in responding to information requests, supply chain rerouting for security of supply or national security concerns, and prioritization of medical equipment, PPE, etc., for the trade processing capacity that did exist, all creating additional barriers for the access of critical short-term working capital for SMEs to underpin trade and economic growth. One result has been the constraining of the supply of capital to banks in emerging and developing markets, who now can't get ready access to capital from regional or global financial centres like London, preventing the companies we want to see trade more from accessing working capital that they need to trade. On top of this, the trade finance gap increases the risk of SMEs being forced towards unregulated or shadow forms of finance, reducing transparency in financial markets. No one wins from such a situation. But there are some positives to take forward from this period. First, we have much more data to help us understand how supply chains work and where the barriers are. And just like the unprecedented success we have experienced in making working from home a reality in short order, in trade finance, we saw market innovation and regulatory concessions emerge to compensate for inabilities to move physical documents, and it worked. Today's challenge is to build on this experience to better enable SMEs to drive the economic recovery that we want. And for that, we must revisit the regulatory frameworks, because trade finance gap is a trade issue, not just a finance issue. If SMEs can't access finance, they can't drive the economic recovery. And we need to drive down what is seen as a prohibitive cost of onboarding SMEs to bring more SMEs into the regulated finance system. On average, we estimate this cost is around $60,000 per SME, with a further $80,000 per SMEs to transact paper documentation. And we need further to address capital cost and regulatory risk models, as despite the ICC trade register consistently proving that trade finance is a zero to low risk activity, trade finance rejection rates among SME applications remain unjustifiably high. The good news is that we know where the solutions are if there is the political and regulatory will to fix the problems. The first thing, ICC has called on governments to reform laws to handle trade documentation in digital form and align legal frameworks to the UN Commission on International Trade Law, the Model Law on Electronic Transferable Records, MLETR. And the prize is significant. ICC UK's recent study found that legal reform and harmonisation would deliver £1 billion in additional trade finance, which would reduce the UK trade finance gap by 50%. The G7 business case for legal reforms published yesterday points out the following: that digitalising the trade ecosystem could increase trade across the G7 by nearly $9 trillion, or nearly 43% on 2019 values by 2026. Paperless trade facilitation could create $267 billion of additional exports compared to the base forecast, again by 2026. But digitalizing the trade ecosystem could create as much as $6 trillion in extra exports in the next 5 years. And a fully digitalized trade ecosystem will result in an average 84% reduction in trade costs, it's estimated, across the 27, again by the same date. Digitalization will reduce bureaucracy by reducing the time spent in cross-border trade by around 81% across the G7. It will cut the number of days associated with compliance at the border from an average of 25 days to less than 1 day. And it will reduce average compliance times from over 2 days to less than half a day. This analysis, even if it's slightly wrong, is overwhelming proof that government action on legal reform to enable trade documents to be handled in digital form and to align legal frameworks to MLETR can be of significant value to tackling the trade finance gap. The second solution, and something I've been personally involved with for some time, is finding smarter ways to manage AML, KYC, money laundering, know your customer. We need to find a way to reduce the volume of red tape and compliance requirements covering anti-money laundering, know your customer, and now know your customer's customer. This is driving up the cost of onboarding SMEs, or worse still, for some banks, it makes them uneconomic to deal with. Now, we're certainly not saying that we want to reduce controls in this important area. What we are saying is that we need governments and regulators to work with the industry to implement digital identities, beneficial ownership registers, and share data more widely, and further to make wider use of technology to find smarter, more intelligent ways to meet regulatory requirements without creating fear of disproportionate sanction for the inevitable errors that do arise, given the number of transactions that are being processed. And in the UK, ICC is doing just this, providing an impartial forum to explore solutions with the support of government. The third area for attention is addressing the regulatory framework of Basel III. Evidence gathered by the ICC over an extended period shows that trade finance is a low-risk activity and justifies a more proportionate regulatory regime than other forms of higher-risk finance. The Basel III framework has made steps in the right direction and continues to improve, but more can be done to treat trade finance as a separate asset class, with consideration being given as to what further measures or flexibilities can be introduced to support enhanced economic growth post the pandemic. London is the leading international financial centre and a critical source of capital to banks in emerging economies, is uniquely positioned to initiate the dialogue with global regulators and institutions and to take the lead in finding a solution. The recent call by the UK government to include competitiveness within the regulatory mandate is a helpful step forward to taking on this challenge. And finally, and importantly, the fourth area, to promote innovation and nurture our fintech communities. Fintechs are now a core, essential component of the trade finance market, providing smart tech solutions and more accessible platforms for SMEs to access the capital they need. While banks remain the single largest source of regulated capital, fintechs have shown themselves to be nimbler and more innovative, and so the combination works well. Both the UK and Singapore are great examples of countries who've built booming fintech sectors through regulatory support and encouragement, and the benefits to the entire financial ecosystem are clear to all participants. Sharing this experience and best practice more widely in terms of regulatory policies and concessions that help fintech scale into markets has to be part of the solution to further innovation in trade finance support. And trade finance is ideally suited to digitalization, but this needs to be done in a coordinated way globally to ensure interoperability and so reduce trade finance frictions and costs. Fintech is ideally placed to contribute to this. So in conclusion, the good news is that the trade finance gap is soluble if governments, regulators, and the industry work together on the four solutions outlined above. Digitizing paper documentation is a key part of the solution, but so is addressing the regulatory frameworks and nurturing our fintech communities. And there doesn't need to be any compromise on financial stability or system integrity issues. As governments design policies to build back from the pandemic, they should see fixing the trade finance gap as low-hanging fruit and mandate the cooperations necessary to deliver this. If there is one lesson we can draw from the pandemic, it's that when industry and government cooperates and focus together on the big picture opportunities, together we can deliver transformative solutions that were never thought to be possible previously. Thank you for your attention. Chris, back to you.
Thanks, Douglas. Terrific speech there. I mean, I think there's so much to go at here, and the panel will pick up on these sort of four areas of solutions. So what I'd like to do now is introduce you to our moderator. We're very privileged to have Marc Auboin, the chief economist of the World Trade Organization, and someone we know well really at the heart of the trade finance conversation in Geneva. For those that aren't familiar with the role of WCO, Marc is a key player and a key influencer, key decision maker in helping enable us to get the right policy frameworks into place. So Marc, if I can call on you to take forward the panel discussion, over to you. Thank you very much.
Thank you, Chris. You've been too generous. I'm only the deputy to the chief economist in the WTO, and I will be speaking on my own capacity today. I will make no further introduction. I'll be just presenting to the audience the panel today, and it's an excellent one. We have Jesse Chenard, the CEO of MonetaGo, a Fintech solution provider. We do have Kristofer Tremaine, the CEO and founder of Kimura Capital, an asset management firm HQ'd in London, providing alternative to bank funding. We have Bhavna Saraf, product head for the Bank of the Future at Lloyds Banking Group. And hopefully we might have Chivunga, who's experiencing a little bit of a connectivity issues. And she's a government advisor as well as an investor, a government advisor to many governments. And I would like to organize the discussion around essentially two questions. I mean, we know that trading SMEs, particularly SMEs exposed to international trade, are facing special working capital needs and trade finance needs, not the least because when you're producing for an export contract, you might have to pay for the inputs, you might have to pay for imports in order to be able to export, and therefore you have a working capital flow that is particular, and you're still facing the constraint of not being able to be paid immediately as it's an export transaction, and the importer might not want to be paying right now. So there are a number of delays and issues with respect to the working capital cycle of international firms, and SMEs are known to be relatively cash constrained. And still, when you're looking at, as Sir Douglas mentioned, the rejection rates for SMEs, more than 40% of SMEs, even in the developed countries market, requests for trade finance are being rejected. Then you feel that there is something that is not working right in the market. Why? Because, as was said before, trade finance products are one of the safest proposition of the financial industry, regardless of the size of enterprises. And we know that from the ICC trade register. So I have two essential questions I'd like to ask the panel. And the first question is, what can we do to improve market efficiency and reduce SME working capital and trade finance gaps? And as a sub-question of that first question is, what is the role of technology and innovation? So that is the first broad set of issues under the first question. The second question is, what is the role of large financial centers in diffusing innovation and technology? And how would such innovation that eventually pop up in these large financial centers, the alternative financing, the reduced costs that come from digitization, the better legal practices and all of that, be best introduced in the most challenging markets, which tend to have in proportion the largest trade finance gap. So let me return to my first question, my two sub-questions. So the first sub-question is, we heard it somewhat in the presentation, is that the gap seemed to be the combination of multiple factors, high costs, like transaction costs, compliance costs, fragmented legal frameworks, particularly when it comes to the recognition of electronic documents or electronic signatures, information asymmetries, that's very important, and notably a gap between the perception of risks, particularly during periods of crisis, and the still relatively low default risk on trade finance instruments, including for SMEs. So what are the market infrastructure that needs to be improved to reduce these costs and asymmetries? And I would like here to call on, let's say, to start up the discussion, Jesse, perhaps to be followed by Bhavna, perhaps, and then Kristofer. Jesse, the floor is yours.
Thank you, and thank you, Sir Douglas, for that great keynote there, and ICC for hosting this this wonderful event. So I come from the latter part of Sir Douglas's points there. I run a fintech company, so we have been primarily focused over the last several years on trade finance and ways to de-risk transactions in the space. My viewpoint is that it's a very big problem. So, the notion around standardization is something that has to come into play. It's very easy to create digital islands. We've created one of the first sort of anti-fraud registries in India around invoices and factoring there. But now, how do you scale that globally? How do you expand beyond that? So, creating standards, creating places where other competition can work together, I think is very important. And then as these projects become successful, like the Contours of the world and the Marco Polos and the WeTrades and all the different efforts that have started out there, exactly to your guys' point, the legal framework needs to be in place. We did a transaction around commercial paper in India, completely legal, but we couldn't use our digital signatures. We had to get the government-approved digital signatures and make sure that was all aligned with what the regulatory bodies thought. So we were able to sort of pigeonhole something in, but again, in a single jurisdiction. And obviously, in international trade is really the holy grail of how do you get this all to work together. So, I think our role as fintechs is to identify technical ways to solve these challenges, which I think we actually have the easier piece of it. But then also, how do we then work that into markets? How do we get major commercial center support, and then thus, a more flowing of liquidity? Because it's truly the enemy of trade finance right now is paper, and digitization of this requires acceptance of legal documents, acceptance of legal digital signatures, and things like that. So, in a nutshell, that's kind of where I feel that we can really help, and sort of where the gaps are in the global market, but especially in developing markets.
Thanks, Jesse. And it's very true that during the pandemic, at the worst time of the pandemic, the real lockdowns in Europe and in China last year, there has been one-off recognition of electronic signatures, and without that, a lot of the merchandise wouldn't have been able to be moving. The second thing that I found to be interesting in your intervention is also the fact that fintechs help to close a lot some of the asymmetry of information with respect to putting in perspective the risk, the credit risk of individual borrowers, an information that sometimes is not collected right, and fintechs are having a role here. Bhavna, what is your perspective?
So hi Marc, and good afternoon, everyone. I just wanted to say thank you for having me today on this session. Marc, if it's okay with you, I just wanted to set the context about, why does the problem exist? I know Sir Douglas kind of alluded to it in the most eloquent way, but just for the audience here, I will just reiterate a couple of things. As we know, working capital is a really important financing tool, which is at the heart of the day-to-day operations of small and medium-sized companies. And this is what really keeps their businesses viable. And, while this financing only extends between what we may think at the face of it between the SME client and their sort of domestic relationship bank, people often forget that because it's a cross-border trade, there are ongoing relationships that need to take place, the bank-to-bank relationships that really add to the end-to-end execution of that particular trade or transaction. And this brings along with its own set of sort of KYC due diligence issues that the banks themselves need to resolve between themselves. And we also know that the access to this financing is not uniform or consistent across markets. I mean, certainly, it's more exacerbated in emerging markets, and I'm sure Michelle is going to pick up on that as well. And what the market data is telling us that approximately 6% of the trading companies are accessing trade finance through the banks, a fraction of the trading market that we have in this. So what it means is that the burden of injecting liquidity for their businesses really to keep themselves viable for small and medium-sized companies really means that they have to either resort to taking out insurance or availing brokers or alternate financiers, often at a prohibitive cost. So for a small and medium-sized company, this means like, time value of money and accessing financing is a big, big pain point. They can't put certainty around their cash flow. Their confidence to seek and deliver commercial commitments gets impacted. And, they really are not able to manage their growth ambition. And for financiers, especially banks, what it means is that, the AML and KYC regulatory obligations that are imposed on us means that, the onboarding processes are cumbersome, which takes time and effort, and, our ability to service this demand, because each bank has to do their own set of KYC and et cetera. So you're almost duplicating not just the effort, but the cost that goes towards actually executing on that transaction. And of course, the fact that you're dealing with paper, I think Jesse alluded to it, brings in the whole fraud element associated with it, because, you could have paper kind of trading at multiple places. So you can see that, there are, various things that add friction to this equation. So in terms of answering, how should we solve for it? There are, I would say, three main areas that from a banking perspective or the financier's point of perspective that I'd like to kind of share with this audience. The one is, how do we increase viability of onboarding SMEs, right, as our clients? How do we make that onboarding, really relevant to it? How do we reduce the burden of, the KYC due diligence that needs to happen between banks? And then finally, how do we take the cost out from the rails around transaction execution? So for the first one, I think what we are thinking, the way we're thinking about is to reimagine some of the lending models for SMEs, to what they are today. So today we have a broad brush approach, whether it's a small or medium-sized company or it's a multi-billion-dollar company, we just base the lending decisions around, what the cash flows are telling you. Is there merit to kind of look at alternative ways of kind of extending credit and underwriting for SMEs, which are smaller companies, mostly transactional based, et cetera, because we know that I think it's been alluded to before, Marc, you mentioned about the trade asset is inherently low risk, right? Where the proceeds are going, you have full visibility on the end-to-end transaction. So perhaps there is merit in kind of raising and reducing some of those controls. And I think I'd like to make sure I clarify this. We're not talking about not having controls. We're just trying to make sure we make them relevant to the type of businesses that we are dealing with. And I think the other important point is that when you're thinking about financing to SMEs, individually, the quantum of financing, is not systemic to a material failure in the system. So even if, there is a default, it's not going to make that systemic sort of impact in the industry. So perhaps there's merit of kind of relooking some of our underwriting and onboarding controls around SME. And I think the second bit is about, reforming the legal infrastructure that provides those rails to facilitate the cross-border transaction. And I would say even for that matter, the domestic trade, bringing some of that legitimacy and efficacy to electronic form that Jesse kind of alluded to, which would ultimately, save the time, the cost for all the parties involved, bringing some of that frictionless and ease of access to finance. And not to mention the sustainability agenda, which inherently it would fulfill, not dealing with having to deal with paper. And I know, I think Sir Douglas also alluded to it, that ICC has mobilized two main working groups around that. One is the digitization and legal reform, and that is actually having fantastic traction in UK, with planning to pass the bill in summer next year. So it's no longer about, the question about if the legal reform will happen. It's just a matter about, when it'll happen, which we know it'll be summer next year. And I think this traction, even though the impetus is led by ICC, we're seeing, it gaining share of mind with WTO as well. And once that all is done, then the partnership with fintechs is actually, for the solution enablement, would become just a logical, natural step. And I think from a bank perspective, we are getting ready to respond to that. The changes in the governance, soliciting interest from a pilot cohort of clients who we can test this change with. And I think some of the figures that were mentioned at the top of the call, I mean, I can give you one more figure here, is that, 90% of UK GDP is tied with the SMEs here. So, trying to solve for them is really critical for the economic growth of the country. And from a Lloyds perspective, we bank majority of this client base. So, we're really committed in helping not just create the solution, but helping Britain recover in this manner.
Thank you, Bhavna. So in some of the points I picked up in your very rich intervention were, well, first, the fact that in emerging markets, if you think that access to working capital is difficult in the developed and a fairly sophisticated market with plenty of alternatives, then we have to think about these markets where onboarding costs are very high because of lack of risk identification tools. That's one thing. You said also sometimes of risk mitigation. So you have to get to resort to credit insurance, for example. And sometimes it just doesn't exist. It's not even offered in the country. And I have many examples in my mind. And the cost simply of duplicating information that is necessary for due diligence. And you're hinged on the correspondent banking relationship issue. As you know, about a quarter of the world's correspondent banking relationships have disappeared in the decade that followed the global financial crisis. And the industry has done a lot to promote registries in order to provide the banks with information, basic information about banks and customers about due diligence. And the SWIFT, for example, KYC registry is one example, one good example. And you gave also a number of solutions with respect to legal issues. May I just take that opportunity to call on Michelle, because I saw that I think she managed to connect with us and to give her own perspective precisely of working around the world on these issues.
Yes, thank you so much, Marc. I hope you can all hear me. I
Yes,
had a little,
yes,
I had a little connection problem here in Dubai. But thank you so much for the introduction, and it's really wonderful to be here with everybody. Thanks to the ICC for hosting. I find it fascinating when we talk about small, medium enterprises, because obviously I'm quite so heavily involved within the SME space. I think for me, there's a number of things. I think the first really is more around the call for collaboration between different stakeholders, especially when you talk about, we've heard already from my earlier speakers around the need for fintechs, for example, to work quite closely with the established financial infrastructure that exists today. But I think that collaborative piece is not quite as advanced as it could be. And we could really kind of reap a lot of benefits from that collaboration if we can improve the collaboration between fintechs and, for example, maybe traditional commercial banks. The reason I say that, because SMEs, regardless of where you are in the world, many SMEs really struggle to access finance, number one. Two, they also struggle to access information, or they access information and it's not necessarily the accurate information that they should have. So there's a number of areas, I think, where, collaboration, I think, could play a very, very important and almost transformative role, right? So in terms of access to finance, obviously, we've heard a little bit around the importance of looking at alternatives. I think in the market that we're in today, where we're seeing, a growth within sort of, for example, digital assets market space, as well as, transformation that's also happening within the traditional financial spheres, I think it's important that those two worlds somehow, need to kind of come together and see where we can actually create packages that are tailored, more for the SME. And when I'm talking about SME, obviously it's quite dynamic, group of businesses that we're talking about. So SMEs in the early stages versus SMEs who are starting to scale and grow require actually very, very different things. And in order to support those SMEs throughout their journey, I think it's important to make things a little bit more tailored. Where you have, for example, you're working with, large scale accelerator programs that offer things like business support and access to information, but they can find this stuff all in a, one-stop shop, rather than being offered by so many different providers that they can't navigate. Because remember, SMEs have very little time. So for SMEs, it's always a challenge, I think, to understand actually who can I go to for that one-stop shop to be able to be supported, right? So, I think it's very important that we think about that. And in scenarios where, for example, the traditional financing institutions cannot service the SMEs, I think it's important that we have some sort of referral system in place so that these SMEs can also be referred into other alternatives, either to support them to access finance or to just support them to access information. Now, when we look at it at a macro level, I mean, in terms of what's happening around the world for SMEs, everybody is quite keen to actually support SMEs. I think the challenge is actually ensuring that they can be reached, especially when we talk about underrepresented SMEs, which is another category of SMEs that I think are very poorly served, right? So if we're able to understand where these SMEs are, how we can reach the SMEs and how we can make the services or products, offering more tailored to these SMEs, then I think we're going to start to see some differences. And when I say tailored as well, I'm also thinking about, women-led businesses. When we talk about emerging markets or developing economies, for example, in Africa, 70, 80% of the businesses are SMEs. And they are really the ones that are generating that economic growth. So how do we support the SMEs? Obviously in Africa, we've had a very big policy shift, for example, around the CFTA, the Continental Free Trade Area. And with the Continental Free Trade Area, again, you have a very solid policy foundation there to enable these businesses to actually have a bigger role to play within the economy. So for me, the collaboration piece is very important. But your question was more around actually how can technology help? So again, without repeating a lot of what's already been said in terms of using technology as an enabler, I think it's also really important to understand technology alone is not necessarily the answer, but can be the enabler. So I think the combination of technology, the combination of maybe that human capital, and ensuring that we've got the right skills, to deal with SMEs and the right packages within the institutions to deal with the SMEs is actually very important. So for me, the core is actually we need to start to become a little bit more creative and be able to pivot and to reinvent our business models. Even the traditional financing environment need to reinvent our business models so that we can service SMEs better. So in order for us to do that, I think it's important to also understand the SMEs. So better research, especially around the underrepresented groups so that we understand who they are. And we can tailor the packages and offer, kind of packages that are suited for these SMEs. I think I'll stop.
Thanks very much. Yeah, thanks very much, Michelle. Before I would give the floor to Kristofer, I'd like to highlight some of the points that you just made. It's all about closing the gap about risk perception and information, and that's where technology might play a big role. And we'll come back to this with a bit more specifics. Information. The banks in the emerging market wants to know who they are facing, right? And in areas where you do not have proper bookkeeping, the companies do not have a legal entity identifier. There are several company registries. I mean, let's go down to really what we're talking about. The credit record is not very well known because the credit bureaus are not, providing that kind of information. But on the other hand, the companies do not know what to ask. They do not know what trade finance facility can do for them, although sometimes it is on the list of offerings by the banks. Very often the banks would provide only working capital at the highest possible interest rate. So you need to close that information gap so that the market really matches the demand and the supply for affordable trade finance. And so here I'm talking about countries in which I have been really working. And really alternative finance, because at the end of the day, as you say, SMEs form 90% of the exporting and importing companies in the low-income countries, for example, those which are receiving a lot of trade because, production is shifting to them. So the prospects for alternative finance, I mean, a lot of the SMEs who are not banked either use informal ways of finance when they have an export contract, or they use sort of established, long-standing relationship with their suppliers or their buyers or whatever, but which is not necessarily optimal in terms of the price and the cost and the process. So thank you very much for joining us, Kristofer. What could you do for them?
Okay. Well, thank you very much for having me today. Just by way of short understanding of my background, I've been in the commodity market for 25 years. I've spent 15 years on the trading side of the market, so a user of finance, and the last 10 years as a financier providing liquidity to the space. So having seen both sides of the argument from a liquidity perspective and then as a liquidity provider. So I think we've seen a lot of innovation in technology over the recent years. And we've seen a lot of change in legislation. Both combined factors have added to just an ever-increasing liquidity gap in the markets. So I think one of the issues on the innovation side is that there's just so many different systems, and it's difficult to say, okay, what needs to consolidate with what to become the most efficient hybrid of all. And I know Jesse and Bhavna are very hard at work developing some fantastic innovations to the market right now. But really, without the capital availability, none of it works. So it's about how to bring more liquidity into the market. And since the last global financial crisis in 2008, the growth of alternate financiers like Kimura has blossomed somewhat. But they themselves are, suffer great inefficiencies as well. So as an alternate financier, we can, being a group of commodity or trade experts, we can move very quickly. We don't have much red tape. I slightly disagree on the cost structure, but that's a discussion from another time. I think we're very competitive. But for us, in order to deliver liquidity to the market, we have to raise money. So we have to go into the investor marketplace, and we have to convince investors that trade finance really is a safe place to place their bets, and we will return stable, consistent returns. Now that, based on historical data, based on wonderful analysis that the ICC put forward, is one thing. But an investor, when investing in an asset manager, is taking direct risk exposure to that asset manager, not necessarily just the market. So therein lies the problem, because a lot of the real big allocators of money won't come in until you have a substantial track record or you have substantial assets under management. So just by bringing a whole group of alternate financiers into the market, it solves for some of the problems. But if we all got together and fulfilled our roles more efficiently, we would certainly provide solution for the greater good. One of the major issues that we've seen historically, and we've touched on it a few times with Jesse and Bhavna, is the way that the credit model has been established historically. So credit loosely based on historical analysis of a corporate's balance sheet history. Okay, great. As we know, as soon as a small corporate takes out a loan, that's an immediate negative impact on their balance sheet, right? So we can work on cash flow models. That's a great idea. We can work on more efficiency of payment history. That's another great idea. We believe anything that is causing that kind of credit bottleneck should be viewed as a non-credit transaction. And I mean having a title ownership structure or a repo type sale and repurchase, where it sits as a true sale on the corporate's balance sheet and actually operates as a credit enhancement and not a negative impact. So I think moving towards that kind, and I know there are some innovators out there providing solutions to deliver that exact issue. But we're not only seeing SMEs that are really struggling, high commodity prices and high trade prices. We are absolutely inundated with trade requests from everyone from a company worth $100,000 to a company worth several $1 billion. So liquidity pinch right now is really facing everyone. SMEs, we know, are absolutely critical as a key economic driver, and they need to exist to ensure competitiveness and job growth and all of the key S parts of ESG. that having those entities in the market deliver. Again, another problem with innovation is user acceptance. We can get the middle market and the top end of the market to accept digitization very, very easily. It's how do you get a cocoa exporter in Ivory Coast who's been using a chalkboard for the last 40 years to immediately adopt encryption key. And so there are challenges that sit within that. And I think the more and more we move forward, there's more innovation to fulfill that. But those are really the gaps that we see, that all the four pillars, if you like, of innovation, finance, legislation, and regulation all need to come together. Because otherwise we see this financing gap going from $3.5 to $5 trillion before we know it.
Thanks, Kristofer, and thanks very much for this analysis. What I'm getting from what the technology can do for you is improve the analysis of the credit risk and generally the risk, and that is already closing some of the information gap. Bringing new investors, for example, platforms, alternative financier and platforms that match investors and demanders' working capital needs. There are a number of platforms that are doing that already. You help the due diligence process. You cut down on documents cost. You establish database to do the due diligence, so you don't do it twice, and all of that. So technology can do a lot for you, but there are challenges, and you've all laid down the challenges adopting, new processes in a relatively, particularly in some sectors which are relatively traditional and that have some comfort in doing business in the way they've been doing it for many years. Some legal challenges of interoperability, also the different solutions that are existing, which one to choose. So these are the things that appeared under the first question. So my second question, and that's the one for which we have only 10 minutes left, which is what is the role of large financial centers such as London in diffusing those innovation and technology, and how does it get to those financial centers that are emerging, and that would get to where the gaps are the largest, because this is where trade is going. As for example, China is now delocalizing, its textile industries or light manufacturing industries in low-income countries, in which the local financial sector is still very, very traditional and has a little, small ability to support that new trade. So what would be the role of leading innovative financial center? And let me start with you, Kristofer, and then we'll go around the panel.
Okay, I'll be as short as I can. Really, trade finance becomes the final frontier for capital markets. You're talking about an asset class which, as we know, has great credentials as an investor product, but it has no standardization for institutions to access. I think the last figures that I saw that made a lot of sense were in 2018, banks distributed around $400 billion of trade finance assets between them, but only 100 billion externally to other investors, such as insurance companies and so on. So I think a standardization, and I know there are firms out there which are also creating great innovation and be able to produce notes, for example, which are more familiar to the capital markets in order to standardize to get the capital in, because liquidity really is the key here. And without liquidity, we can do whatever we want on the other side. The system just won't work. So for me, really supporting a standardization of the democratization of trade finance assets to allow the capital markets in, we'll see, I believe, within a decade, the trade finance as an asset class being worth about $3 trillion as a capital market product. And that will compete directly with bonds and equities, and indeed be substantially larger than the entire global corporate debt market.
Thank you very much. Michel, you've been mentioning, the very large rejection rates in the emerging markets. 70% of women-owned SMEs requests for trade finance in the ADB studies are rejected. how can this bubbling of innovation happening in London get its way to the traders in the developing countries?
Yeah, I know it's a fantastic question, Mark. Thank you. I think that number is actually worse now during COVID times. So you've had a lot of women-led, especially women-led businesses not really getting any sort of support or capital to support their businesses. So for me, I think it's a couple of things. First, there's this kind of not reluctance, but that perceived risk that we probably talked about earlier on around investing into women-led businesses. Also partly, back to my comment earlier on about really knowing and identifying these businesses and removing kind of that risk perception that we have around the women-led businesses is another issue. But also in the developing market side as well, it's very difficult again to have the right information in order to make a very informed decision about whether to invest into these businesses, because again, you don't have the credit history that we talked about. There's very little information. KYC isn't necessarily strong. Onboarding activities also can be quite costly and expensive. And a lot of the women themselves also find it a bit of a challenge to actually approach and try and get finance from the traditional models. Now, some of what we're seeing, that what's changing at the moment, because there's also a heavy adoption rate of alternative financing in Africa, especially when you're looking at things like cryptocurrency, which is a little bit easier to navigate for some of these businesses. We're starting to see actually some interest and some interaction happening around that space, because it's becoming a little bit easier, I think, to get into that space. The other thing is also very much around actually the SMEs themselves positioning themselves, so having the right investment readiness, right, to be able to access some of the financing. Now, in terms of what actions do we need to look at, I think we need to be a little bit more tailored. Again, I think I said this earlier on, tailored in our approach in terms of the response that we provide, especially women-led businesses, because they do face some very, kind of specific barriers, I think, when it comes to trade finance for women. There's a number of initiatives, I think, even from the African side. For example, the African Development Bank has a very clear, fund that supports women-led businesses across the continent. Because they have obviously noticed the gaps. But also, I think it's about strengthening the local capital markets within sort of Africa itself, right? So, having that local high levels of investment or high levels of, initiatives that can support those businesses that are in those markets. When we're talking about from the UK end and what role can the UK play, I think a very significant and huge role actually in supporting that infrastructure. Even today, I was having conversations with the IFC, who have gone and also heavily, put aside a large amount of money to support more SMEs and women-led SMEs especially. So I think when it becomes a little bit more tailored, and there's that less perception of the risk, or even if we think that it's more risky, then there should be better insurance products, for example, and better guarantee products as well, from the banks to support these businesses. I think it's also about, back to my point earlier on, around understanding the businesses, actually doing the research and ensuring that we start to understand who these businesses, how can we reach them, how can we make it more tailored. And obviously being able to re-innovate around the packages that we do exist, or the trade finance packages that are on offer, bearing in mind what the specific barriers are for women, I think is actually quite important.
Thank you so much, Michelle. I'm sorry we were running out of time, so please 3 minutes each for Bhavna and Jesse about the role of large financial center in diffusing innovation and technology into the rest of the world. Perhaps Bhavna and then Jesse. 3 minutes.
Okay, I'll be fast, Jesse. I'll give you the floor as soon as possible. I guess your question around, what role UK can play, I think we're already seeing that in motion, to be honest with you. The whole work that we have around legal reform, if we are able to actually get that bill passed next year in summer, that's going to be a milestone in English law, because English law is very transportable across a lot of jurisdiction, given the Commonwealth nature of the countries that we have around the globe. So, once it's approved, I think it should be a good and easy replication for us to be able to do. And I think some of the points that Kristofer had mentioned about, being a financial hub, and kind of capital structures and solutions that are coming up here, creating that sort of tradable asset class for trade assets is, I think, going to be a game changer. We have seen attempts of that. And if we can really do that, then it becomes a very competitive asset class there. So I would say some of that is already in action, and I think more to come for UK there. Jesse, over to you.
Thanks, Bhavna. So yeah, I kind of think that London, as everyone has pointed out, London, can have very transportable laws to other jurisdictions. We've done a lot of work in more developing worlds and in Asia, and looking at what the Indian government has done with the trades exchanges, opening up access to SMEs, they're mandating that the corporates and then what have you and the banks come on board, has really opened up the market for them. It's growing and growing more. And then you look at governments like Kenya with the M-Pesa technology, and they're allowing digital currency to exist. These are all little things that help grow this trade, get us away from paper, get us away from risk. And then regulatory sandboxes, in each of these different jurisdictions, help the governments to understand what's technically possible, figure out which regulatory framework it fits in. And then again, going back to that sort of, if the UK law permeates down and if the banking centers world are comfortable with adopting that common law, you really wind up with a win. It's not just going to start at the top and then trickle on down. A lot of the international efforts that the ICC.
It seems that we have a little connectivity issue with Jesse, but we got your points, I think.
Okay, great.
It would be, thank you very much. It would be a daunting task for me to try to summarize, because it's been very, very dense, and in 45 minutes, I'm afraid we could not. I tried to direct discussion, by the way, in the direction of some of the questions in the chat. So, for example, there were questions on how to boost alternative finance and fintechs in Africa. So there were a number of remarks made. There were also remarks relative to making trade finance a particularly asset class. There are so many other questions that are popping up just right now, for example, on Basel III, on electronic documents. I'm afraid that we're running out of time, but I would like to thank the panel so much for that discussion today, and hand over to Chris, I suppose, or to
yeah, we actually have 15 minutes left, I think, Marc.
We've got 15 minutes left. Yeah. That's fantastic. Then we can tackle some of the questions in the chat, and we've got, for example, does the panel feel that there is enough experience and knowledge within banks about SMEs and the financing opportunities available? Can I direct that to all of you? Well, perhaps to the bankers, to the banker first, but that's a good one. Bhavna.
Yeah, I think it's a great question. I think I'm going to be cheeky and give you a cheesy answer to say, yes, we believe we understand our clients. But I think we also need to understand their businesses in an evolving landscape as well, right? So it's not the same old is not going to really work with what we know. So being cognizant about what is that how is their business going to evolve in that changing landscape with the technology intervention available to us is really key for us. So we are changing our way of thinking about our clients, whether it's SME or otherwise, especially I would say SMEs, because you heard me say that, it's at the heart of, what Lloyds is trying to do, helping Britain recover. And you're not going to do that by not addressing the SME agenda there. So I think the short answer to that is, yes, we are. And we are constantly looking at our solution and making them relevant, faster, cheaper, quicker, more competitive, sustainable, and frictionless for the SME clients. As you heard Michelle say, the core activity that an SME client is trying to do is grow their business. Banking is just a means to an end for them. They don't want to be spending their time trying to navigate the spaghetti of our processes, which are protracted, long, and confusing. So how can we change that experience thanks to some of the technology that is now available to us? You heard Jesse mention some of the POCs that they have run in India. You've heard about Kristofer mentioned about, new trade as a new asset class for investors, etc. So it's a constant, I would say, test and learn. But, we are definitely not staying on what we knew in the past, because that would simply not work. Marc, you're on mute.
I'm sorry about that. Yes, I wanted to know whether Michelle wanted to take that over. And there was an additional question for you, Michelle, as to why would the fintechs, what was stopping fintechs coming into the African market? So both the bank and perhaps lack of alternative, maybe to be followed by Kristofer.
Yeah, sure. Thank you, Marc. I think from the bank perspective, I won't say, yes, the banks kind of have it 100% clear, but I think there's been definitely some significant improvements. I mean, for my time in the banking side, when I was in the banking sector, I have seen quite a lot of initiatives that are, geared towards the SME. So that's really positive to see. But I still think, the speed of innovation or the speed of trying to support SMEs is actually not as fast as it could be. And I think there are a number of, kind of areas where we can improve that, including maybe teaming up, like I was saying earlier on, with the fintechs who have, better user-friendly products and services, but fintechs also struggle in terms of access to the customer base. So the bank have a very strong customer base, and the fintechs obviously have really good user products. So I think there's something around collaborating a little bit more, and I think banks also need to make a better effort in terms of understanding maybe the SMEs that haven't traditionally been their clients. So if you talk about underrepresented groups, for example, diverse businesses, for example, and beginning to understand what they need, I think is particularly important for the banks. But we're starting to see quite a lot of initiatives in place to address that as well. Again, women-led businesses, and ensuring that we can start to segment our customer base, especially for the banks, and start to tailor your products, so that it meets the needs of those customers is really, really important. Again, collaborating, of course, with the fintechs, I think you can get added value by doing that, actually. Now, on the second question around the Africa side, yes, I think in terms on the Africa side, why fintechs not going in? I assume this question, is referring to fintechs outside of Africa, because in Africa, I can tell you there's a big interaction going on with fintechs, and the growth is beyond, kind of really surprising. But at the same time, you can see that there are many fintechs interested to go into Africa. I think it's a case of, maybe starting to understand which markets in Africa might be attractive for fintechs that might be coming from the UK. And also starting to bridge that and giving these fintechs that are in the UK maybe potential partnerships with other fintechs across Africa. So it's giving more information, removing that perceived risk that Africa is very, very risky, better clarity around regulation and the environment. So some people are quite fearful about going into Africa because they're not so sure about what is the regulatory clarity. There's very poor understanding of the economic and political situations in some of the countries. So I think in a way, Africa itself also has to market itself a little bit better in terms of what it has to offer, for the international community. And I think that's starting to happen, especially when you have the likes of M-Pesa in places like Kenya, where of course we're leading around, mobile money and digital currency and things like that. So I think as we move ahead in future, we're going to see that shift a bit, where we're going to see a lot more collaborations between fintechs from around the world. In the UK, in Singapore, it's already starting to happen, and Africa. So I would kind of summarize and say, well, the massive opportunities definitely in Africa, but there are also some challenges that people need to be aware about. And also, they need to understand how to navigate the different spaces. But certainly Africa, I think, is a huge market for UK fintechs to actually start to engage in.
Kristofer, maybe.
Sure, I completely agree with Michelle there. I mean, we've seen huge fintech innovation in places like Nigeria, and I don't think you can say Africa anymore. I mean, it's a very diverse, different place, and one country in sub-Saharan Africa can't be compared with the next one. So, in providing a solution for an alternate financier like ourselves, very difficult to do. As to hate to use the phrase, a group of middle-aged white men from London. So it's very important to seek specialized partnerships and collaboration. We actually do have an Africa product which is run on the ground by experts within each one of those key regions. One of the other challenges is the export market is not the same as the import market. That is a night and day difference. You know, it's one thing sending money into Africa, and then it's another thing trying to get them to send money out. So you know, there's a significant bottleneck on the banking side of things in order to clear capital, which presents massive challenges. And perhaps some of the innovations that we're beginning to see in cryptocurrency in terms of easing cross-border transaction and allowing that liquidity to pass in and out, I believe should make things easier. And of course, the elephant in the room is always the legal system. When you have a problem in Africa, it tends to be a big one. Nothing is as easy as you hoped. And then, you know, leaning on Jesse and Bhavna more from that perspective, with the development of some kind of seamless way of securitizing your risk through Africa, driven by localized Africa experts, with some kind of cross-border payment solution that makes sense and allows prompt clearing of receivables.
Jesse, perhaps.
Yeah, I mean, I think even actually just to continue on Chris's point there, it may not be that ultimately we need a legal framework to make sure that things are securitized and passed along properly, with smart contracts, innovations in blockchain, secure computing, things like that. A lot of these things can be automated in such a way that as things clear certain processes, funds are automatically released, and so that you've got less legal risk there, because the smart contract that's on a public blockchain it reduces that friction. So and I would again reiterate, I think that Africa, there's no lack of fintechs in Africa. You know, if you study the market, it's quite large there. I think one of the things that the struggle is, and I think that was been iterated before, is that each country is very separate and distinct, and getting standardization across them and harmonization has been a challenge. But with global standards, with what the ICC is doing, and then even with companies like MonetaGo, our solution isn't regionally focused. What we're rolling out in partnership with Swift and some others is more focused on a global solution available immediately everywhere. So if you're trading from Africa to Dubai or Dubai to India, it's available everywhere that you are. So, you know, I think that's combination of global solutions and standards will help to start to knit those great fintech communities in Africa together and enable others to operate in that space.
Thank you very much. I hesitate to launch another question because we have like 5 minutes left. There's one that comes relatively prominently in the chat, which has to do with Basel III regulation and the regulation of the trade finance space. And I hesitate to discuss this. It becomes quite active generally when it's being discussed. But just one thing that you might know just as background, and here I'm speaking on my own capacity as a sort of old expert on writing about these things. Trade finance is a very diverse space, by the way. You have letters of credit, which are regulated with a special, on the Basel II and III, with a special regime, because there are only a commitment to pay, and the likelihood of that commitment to pay to come into the balance sheet of bank is relatively small. And there is data about it. There is on-balance sheet commitments, which are essentially lending. There are other things like insurance, which is not regulated by banks, but by insurance regulators, you know, credit insurance. So what we call trade finance is a lot of products doing risk mitigation on different stages. And therefore, although there has been some effort by the industry to define, for example, some parts of trade finance, like supply chain finance, there is a BAFT ICC definition of that. The regulation is more by instrument, and therefore you may be facing different pieces of regulation by the regulators and the regulators with an S, which is, it could be a banking regulator. If it's a banking product, you can be insurance regulator if it's insurance. So I don't know whether it helps, but it provides the at least an answer to the fact that there is no one trade finance category of product for one regulator, and that is not being discussed in this way. So this is only what I would be saying, and that probably leaves us to the end of our discussion. It could be hours, because we've really covered a wide range of issues here, and I would like again to thank so much the different participants to the panel, as well as Sir Douglas, who introduced the subject, and Chris as well. So back to you, Chris. Thank you very much, and I hope you enjoyed the session.
Well, thanks very much, Marc, and thanks so much to our speakers. This is a subject that's very dear to my heart, really. I think I'm confident we'll get there eventually with solutions. I think we're getting more and more focused and smarter actually in the way that we're articulating the solutions, and that's particularly important in the global context. But I do think also, listening to the conversations around SMEs, there is more to be done, isn't there, to try and get access to SMEs, and I'm thinking specifically on the industry side, actually more than the finance side, is how do we bring the business groups, of which there are many, across the emerging markets, closer to the finance community, to kind of get those messages out on the ground to where the networks are. I think there's a huge opportunity there to work with the likes of the World Chambers Federation. Really does jump to mind. But anyway, thanks so much to our speakers. Thanks to our audience, of course. Thanks to our sponsors for today's session. That almost wraps up today. We've got one more session coming up on establishing a cyber secure environment. That kicks off at 4 o'clock British Standard Time. That's also a really critical subject that keeps coming up, is how do we create, when we do go digital, how do we create a secure, safe environment from a cyber perspective? So if anybody wants to know more about that subject, we've got some of the leading lights, including Vint Cerf, one of the kind of founders of the internet, guiding us through that conversation and what's going on at the United Nations. So thank you very much for everybody, and we'll call the session to close. Thank you.
Thank you
very much.
Thank you.